This is a weekly chart for the Emini S&P for the 17th of June. Last week we warned that the Emini S&P had diverged quite a long way from the 100-day moving average, and this is starting to worry us. We weren't looking for a big sell-off, but we'd certainly had warned of that at the beginning of last week as we approached this trend line up at the 1959 area. We never quite made it as far as 1959. That 1955 level held it, in fact. Last week's candle is quite negative, but again, I don't think there's any reason to panic. I don't think this is going to trigger a huge sell-off in the S&P just yet. But it's worth noting that the tone is slightly more negative after last week's correction, which, as I said, wasn't unexpected by any stretch of the imagination. So we had a couple of negative candles. Friday's candle was more positive. Yesterday we were just consolidating. I think we can start to build a recovery now. We've nicely unwound what was a seriously oversold situation on the daily stochastic going back to the end of May. That's going to help bulls to feel encouraged to come back into the market. I think we haven't broken any significant support. A couple of down days doesn't matter really. If I go to the 4-hour chart, you can see we've held good fib support around 1919, and we can start to build this recovery now. We can hold above the short-term moving average at 1925, which seems to be working more recently. All we need to do then is get back through the 1932, 1933 area, and this market will start to look more positive. Obviously, a break below last week's low of 1919, however, certainly would be a little bit more negative and could push us down to the low 1900s.